Silver price, surge. Are we heading back to $100? Silver, the metal that built empires, backed currencies, and quietly disappeared from your pocket change. For decades, it has been sleeping. But right now, central banks are moving, oil routes are being threatened, and the most powerful investors on the planet are buying something you're not being told about. The last time these exact signals appeared, silver did not just rise, it exploded. And what is coming next may make that look like a warm-up. Welcome to The Boring Currency, the channel where we do not chase trends, we read them. Now, before we go any further, if you have not subscribed yet, think of it like this. You would not leave the house without your reading glasses, would you? Do not watch the markets without us either. Hit that subscribe button, it takes 1 second, and it might save you from a very expensive mistake. Also, we would genuinely love to know, where in the world are you watching us from right now? Drop your city, your country, right there in the comments below, because this story is relevant wherever you are. Now, let us begin. The year is 1980. Two brothers from Texas have just done something that no private individuals had ever attempted in modern financial history. Nelson and William Hunt had quietly accumulated over 100 million ounces of silver. They believed the American dollar was dying, and they were determined to protect their fortune by owning the one metal that governments could not print. As they bought more and more silver, the price began to move. It crept from $6 an ounce, then $10, then $20. Wall Street started paying attention. Ordinary investors began to panic buy. And within months, silver had rocketed to nearly $50 an ounce, a price so extreme that it sent shockwaves through the entire global financial system. Then it all collapsed. The exchange changed the rules mid-game. Margin requirements were tightened almost overnight. The Hunt brothers could not hold their positions. Silver crashed back down within weeks. But here is what most people never discuss. The real lesson was not about two greedy brothers. It was about how quickly silver can move when the right pressures align. 3 decades later, history began to rhyme again. In 2011, silver surged once more, and this time reaching $49.51 an ounce. The world was still recovering from the 2008 financial crisis. Governments had printed trillions of dollars in emergency money. Investors were terrified of inflation. And silver, once again, became the asset that serious money quietly ran toward when confidence in paper currency began to crack. What makes silver unique among all metals is its dual identity. On one hand, it has functioned as money for over 4,000 years, longer than any government, any bank, or any currency in existence today. On the other hand, it is one of the most industrially critical materials on the planet. No other asset carries both of those qualities simultaneously, and that combination is precisely what makes it dangerous to ignore. Throughout history, silver has never stayed cheap for long when the macro environment turned hostile. Empires from Rome to Persia measured their wealth in silver. The Spanish colonial economy was built entirely on silver extraction from South American mines. Even the United States dollar was once legally defined as a specific weight of silver. The metal is not a relic, it is a barometer, and right now, that barometer is under enormous pressure. What serious analysts are observing today is not a random price movement. They are watching a very familiar pattern reassemble itself, piece by piece. Central banks are buying precious metals at a pace not seen in over 50 years. Global debt levels have surpassed anything recorded in human history. And the confidence in paper-based financial systems is eroding quietly but unmistakably across every major economy on the planet. The $100 silver scenario is not a fantasy invented by internet speculators. It is a mathematically documented outcome that occurs when specific conditions converge. Those conditions have appeared twice in modern history, 1980 and 2011. Both times, the world ignored the early signals. Both times, the move happened faster than almost anyone predicted. And both times, only those who had positioned themselves early walked away with generational wealth. The question being asked in serious investment circles today is no longer whether silver will surge again. The question is whether the world is paying attention early enough this time. The signals are not hidden. They are not complicated. They are simply being overlooked by the same majority that has always arrived too late to every great monetary shift in history. The story of silver is not just a story about a metal. It is a story about what happens when the world finally stops trusting the paper in its pocket. And that story is far from over. There's a quiet war being fought, not with weapons, but with gold bars. Over the past 3 years, central banks across China, Russia, India, Poland, and Turkey have been pulling their reserves away from the US dollar and moving them into physical gold at a historic pace. Most headlines missed this story entirely, but seasoned analysts understood immediately what it meant. When the institutions that control money start losing faith in money itself, something very serious is approaching. Now here is where silver enters the equation in a way most investors completely overlook. Throughout modern financial history, gold has always moved first. It is the cautious institutional signal. Silver follows, but when it moves with far greater velocity and far greater percentage gains. In 2011, gold rose approximately 30% during its peak run. Silver rose over 175% in the same period. The pattern is not coincidental, it is structural, and gold has already begun its move. Thousands of miles away from trading floors and investment banks, a different kind of crisis is quietly building. The Strait of Hormuz, a narrow waterway between Iran and Oman, is one of the most strategically critical choke points on the entire planet. Approximately 20% of the world's oil supply passes through it every single day. When tension rises in that region, oil prices do not just increase. They destabilize entire economies. And destabilized economies do one thing consistently. They accelerate inflation. Inflation is not simply rising prices at a grocery store. For serious market participants, inflation is a signal that the purchasing power of paper currency is being silently destroyed. When that destruction accelerates, hard assets become the only logical refuge. Oil disruptions feed inflation. Inflation feeds precious metals demand. And silver, sitting at the intersection of monetary value and industrial necessity, absorbs that pressure like no other asset class on the market today. Then there is the gold to silver ratio, one of the most precise and least discussed instruments in all of macroeconomic analysis. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged between 40 and 60. Today, it sits dangerously above 80. What that number tells experienced analysts is not complicated. Silver is historically, measurably, and structurally undervalued relative to gold right now, and these gaps do not stay open forever. The US dollar is facing a pressure cycle that did not exist even a decade ago. BRICS nations are actively constructing alternative trade settlement systems designed to reduce global dependence on dollar transactions. Foreign holders of US Treasury bonds are quietly reducing their positions. And the Federal Reserve finds itself trapped. Raising rates risks economic collapse, while cutting rates risks reigniting the inflation it spent years trying to control. In that environment, silver does not need a catalyst. The absence of stability is the catalyst. What makes this moment structurally different from 2011 is the sheer number of triggers converging simultaneously. In 2011, it was primarily monetary policy fear driving precious metals. Today, analysts are watching geopolitical fracture, energy market instability, de-dollarization, record central bank gold accumulation, and an industrial silver demand curve that did not exist 15 years ago, all moving in the same direction at the same time. That is not a coincidence. That is a convergence. Serious investors do not wait for confirmation from mainstream financial media. By the time a story reaches primetime television, the smart money has already positioned itself and is quietly waiting for the crowd to arrive and drive prices higher. The macro triggers being discussed in private wealth circles today are not predictions. They are present tense realities. The oil risk is real. The dollar pressure is real. The central bank signal is real. The only variable remaining is timing. And timing, in financial markets, is everything. The triggers are not coming. They're already here. The only question left is devastatingly simple. Who is positioned and who is still waiting? Somewhere in the Mojave Desert, thousands of solar panels are being installed every single hour. In the factories of Shenzhen, circuit boards are being assembled at a scale that would have been incomprehensible 20 years ago. In the laboratories of Munich and Seoul, engineers are designing the next generation of electric vehicles, each one requiring components that depend on a single, irreplaceable material. None of these industries advertise what they are consuming, but the numbers do not lie. And the number they all share is silver. Here is what makes silver's industrial story genuinely alarming for anyone studying supply and demand fundamentals. Silver is not simply used in modern technology, it is consumed by it. Unlike gold, which is melted, recycled, and reused in an almost endless loop, silver is used in quantities so small per unit and dispersed so widely across complex products that recovering it is frequently more expensive than simply mining new supply. Every solar panel, every electric vehicle, every smartphone, every military-grade electronic system, they do not return their silver. They bury it permanently inside the global economy. The solar industry alone has rewritten the silver demand story in a way that most financial analysts were completely unprepared for. A single solar panel requires approximately 20 grams of silver. That number sounds small until the scale is applied. In 2023, the global solar industry consumed over 200 million ounces of silver, roughly 20% of the entire world's annual silver supply. And the International Energy Agency projects that solar installation rates will triple by 2030. The arithmetic of that projection, when applied honestly, produces a supply deficit that has no comfortable resolution. Electric vehicles are accelerating the problem further. A standard internal combustion engine contains virtually no silver. A modern electric vehicle contains between 25 and 50 grams of silver embedded across its battery management systems, charging infrastructure, and onboard electronics. As governments across Europe, China, and North America legislate the phase out of combustion engines, the automotive industry is not simply shifting fuel sources. It is quietly becoming one of the largest silver consumers on the planet, whether it acknowledges that fact publicly or not. Then there is 5G infrastructure, a technology whose silver consumption is almost never discussed in mainstream investment conversations. Every 5G tower, every base station, every high-frequency relay point requires silver-coated components to function at the speeds the technology demands. Copper simply cannot perform at those frequencies with the same efficiency. And as the global rollout of 5G accelerates across Asia, Africa, and Latin America, the demand being generated is not a future projection. It is a present-tense, monthly, industrial reality that is quietly draining available supply from the market. On the supply side, the picture is equally sobering. The world's primary silver mines are aging. Discovery of new large-scale silver deposits has slowed dramatically over the past 2 decades. Approximately 70% of all silver mined globally today comes as a byproduct of copper, zinc, and lead mining, meaning silver supply is largely hostage to the economics of entirely different metals. When base metal prices fall and those mines reduce output, silver supply contracts automatically, regardless of what silver's own price is doing at that moment. What is quietly emerging in the physical silver market is a dangerous divergence. On paper exchanges like the COMEX in New York, silver is traded in staggering volumes every single day. Contracts representing hundreds of millions of ounces change hands between institutions that have no intention of ever taking physical delivery. But in the physical market, the market of actual touchable silver bars and coins, supply tightness is becoming increasingly visible. Premiums above spot price are rising. Delivery waiting times are extending. And the gap between paper price and physical reality is growing wider with every passing quarter. This divergence is not a technical anomaly. It is a warning signal that experienced commodity analysts recognize immediately. Paper markets can suppress a price temporarily, but they cannot suppress reality indefinitely. When the physical market finally overwhelms the paper market, as it has done twice before in modern history, the price adjustment does not happen gradually. It happens suddenly, violently, and without sufficient warning for latecomers to react. Silver is no longer simply a monetary metal waiting for a crisis. It has become the material foundation of the modern economy itself. And the modern economy is consuming it faster than the earth can replace it. That equation only ends one way. In the summer of 2010, a relatively small group of institutional investors began quietly accumulating silver positions. They did not announce their strategy on financial television. They did not publish research reports alerting the broader market to what they were doing. They simply moved, methodically, patiently, and with complete conviction in the data they were reading. By the time the general public realized silver was surging in early 2011, those investors had already built positions that would generate returns most retail investors would never see in an entire lifetime. The lesson was not about silver, it was about timing and silence. Today, serious market participants are observing a behavioral pattern among institutional investors that bears a striking resemblance to that 2010 accumulation phase. Hedge funds are quietly increasing their long positions in precious metals. Family offices managing generational wealth are reallocating portions of their fixed income holdings into hard assets. Central banks, the most conservative and slow-moving institutions in the entire financial world, are buying gold at record pace. When the most cautious money on the planet moves this decisively, experienced analysts do not ask whether something is happening. They ask how much time remains before everyone else notices. The first strategic question serious investors are confronting is deceptively simple. Physical silver, ETFs, or mining equities, each carries a fundamentally different risk and reward profile that must be understood before any capital is committed. Physical silver, bars and coins held in direct possession, eliminates counterparty risk entirely. It cannot default. It cannot be diluted. It cannot be frozen by a financial institution facing its own liquidity crisis. In a scenario where systemic financial stress accompanies a silver surge, physical possession is not just a preference. For many serious analysts, it is the only form of ownership that genuinely matters. Silver ETFs offer liquidity and convenience, but introduce a layer of institutional dependency that physical ownership eliminates. An ETF is ultimately a promise, a paper claim on silver that exists inside a financial system that has demonstrated, on multiple occasions, its capacity to malfunction under stress. Mining equities, on the other hand, offer leveraged exposure to silver prices, meaning that when silver rises 50%, well-positioned mining stocks have historically risen 150% to 300%. But that leverage operates in both directions. Mining companies carry operational risk, geopolitical risk, management risk, and energy cost risk that pure silver ownership does not. The framework is not about which option is universally superior. It is about understanding precisely what each option actually represents. Portfolio allocation logic in the current environment requires a level of intellectual honesty that most retail investors find uncomfortable. The traditional 60-40 portfolio, 60% equities, 40% bonds, was designed for a world of stable inflation, predictable interest rates, and trusted institutional frameworks. That world is under serious structural pressure today. Experienced wealth managers are no longer asking whether precious metals deserve a place in a serious portfolio. They are debating what percentage is appropriate, and the answers being discussed privately are significantly higher than what mainstream financial advice has historically recommended. The timing signals that disciplined analysts are monitoring right now form a remarkably coherent picture. The gold-to-silver ratio remains historically elevated, signaling undervaluation. The US dollar index is facing structural headwinds from de-dollarization pressure. Real interest rates, adjusted for actual inflation, remain deeply unfavorable for holding cash. Physical silver premiums are rising steadily in retail markets. And mining company earnings, despite suppressed spot prices, are beginning to reflect the cost pressures that historically precede major supply contractions. No single signal is conclusive, but the convergence of all of them simultaneously is the kind of alignment that serious investors have learned, sometimes painfully, never to dismiss. What $100 silver would mean for broader market psychology extends far beyond the precious metals community. A silver price at that level would represent an implicit verdict on the health of the global monetary system, a public market-driven acknowledgement that confidence in paper currency management has reached a critical threshold. It would trigger a reallocation of capital at a scale that would reshape commodity markets, currency valuations, and equity sector weighting simultaneously. The ripple effects would be felt not just by silver investors, but by every serious participant in the global financial system. History does not repeat with perfect precision, but it carries patterns, reliable, recurring, and readable by those disciplined enough to study them without emotional bias. The pattern assembling itself in silver markets today has appeared before. It has rewarded the prepared and punished the complacent with equal consistency. The data is available, the signals are visible, the framework for positioning exists. What separates the two outcomes, generational opportunity versus missed moment, is not intelligence or access. It is simply the willingness to act on evidence before the crowd arrives. The market does not wait for consensus. It does not pause for the unprepared. It does not announce its most significant moves in advance. It simply moves. And when silver moves, the only question that will matter is, were you already there or were you still watching?